The Obama administration today took the latest step in its efforts to repair the nation's banking system. The Federal Reserve began releasing information about its stress test on major banks. The Fed reported that while reserves had substantially reduced in some banks, most had capital well in excess of government standards. The 19 banks examined hold two-thirds of the assets and more than half the loans in the U.S. banking system. The government privately told bank executives their test results this afternoon. The Fed also released its methodology ahead of an announcement of the results in 2 weeks. We want to talk about the financial sector, the stress test, all of this with a very interesting group of people. Bill Ackman of Pershing Square Capital Management, a hedge fund here in New York. Joseph Stiglitz of Columbia University, co-winner of the 2001 Nobel Prize in Economics. Andrew Ross Sorkin of the New York Times, a reporter and columnist. And Kate Kelly of the Wall Street Journal. I am pleased to have all of them here at this table. I will begin with you. Tell me where we are in terms of what do we know about the stress test? What do we know about the results? What are they telling us, and who cares?
Well, there are precious few details that have been released so far. We're going to know more, I think, on May 4th. But what happened is the banks underwent these stress tests. They had certain parameters they were supposed to run their models against, run their portfolios against, assumptions about unemployment and how severe it would get this year, for example, assumptions about losses on the value of certain holdings that were approximately close to what you saw last year with the Lehman Brothers failure. And the Fed met individually with the bank management today. I think it was CEO, CFO, other senior people, risk officers, to discuss where they stood, right, how strong they were. I think they had 3 buckets from strong to weak, and whether they would need to raise capital. So what's interesting is there's been much back and forth about how much to disclose, and I don't think we fully know what they're going to disclose yet, but what they do will have a major impact on public perception. And even if they don't give us all the details, based on who's raising capital, we're going to be able to make some assumptions. So the government's in a bit of a box.
All right, Andrew, add to that.
Well, so the issue this afternoon, I talked to a number of the executives who have been briefed on their status, if you will. And the question right now is what assumption the government used for their revenue. Right? They did all these other assumptions which they used for everybody across the board, but what they didn't do, they actually for each bank individually said what is their revenue going to be for the next 2 years. And that's the most fungible, if you will, of all of these, because every bank thinks that they're going to have higher revenue than the government seems to think. And so what we're going to be seeing over the next week is a debate privately that hopefully will come out in public at some level over what those revenue judgments are, and that's what we're going to find out. And that, to me, will tell us, in the end, who's strong and who's not, and who we can actually believe.
Okay, but it'll tell us that, and then what will happen?
It depends. And the answer is a bank that needs more capital, where does the money come from?
Exactly.
And the last 6 months, the money has come from the taxpayer. And the question is if that's going to continue. And there are some alternatives in the taxpayer. Right. And this past weekend, Larry Summers was on Meet the Press, and he talked about asset liability swaps as an alternative means to raise capital for the banks. I translate asset liability swap for debt for equity swap, or junior debt for equity swap, preferred stock for equity swap. Basically, what's interesting is that the banks in this country have all the capital they need. The problem is too much of that capital is in the form of debt, not enough in the form of equity. And the way we solve that problem, typically in America, is through a reorganization process where a judge adjudicates a bankruptcy or some other form of conservatorship or reorganization. They figure out the value of the firm. They figure out how much equity needs to be raised. And they compromise the bondholders until the bondholders end up owning the firm. And the benefit of this kind of approach is imagine a bank that needs $100 billion of capital. You can put $100 billion in from the taxpayer, in this case Joe the plumber, putting his money in. The money, unfortunately, is going out the door to pay interest to, call it Bill the bondholder. Right. And that doesn't seem quite fair to me. What you can do instead is Bill the bondholder has to convert $50 billion of his debt into equity, and that magically raises $100 billion of capital, because for each dollar of debt that becomes equity, you're canceling a dollar of debt, you're creating a dollar of equity. And the system was really set up for this. I mean, this is a classic restructuring approach.
Okay. Why have they tried this before? Is this do you think this idea has merit? The idea of Ackman and Larry Summers talking about it publicly?
It's what I've said they should have been doing all along.
This was your idea.
Well, no, what I'm saying is it is what we have done. We did it in continental Illinois. We've done it, and you know, what they've confused confused is the notion of too big to fail with the notion of too big to be financially reorganized. And this is just a simple process of financial reorganization. We do it all the time. The bondholders don't like it, because they would prefer the taxpayers giving them money. And it's perfectly understandable.
Right.
And the bondholders have been, their voice has been heard very clearly. But it's not in our national interest. The banks would be stronger after they do this kind of financial reorganization. They don't have to pay out every month all the interest payments that they had to pay before. They now have all the capital that you know, the leverage right now is huge. So a small change in the value of the assets means that the capital is all wiped out. So now you have more capital, less debt. They're in a better position to go forward. It's basically the notion that we call a fresh start.
Right. So what does Mr. Geithner think of this?
Well, they've been resisting this.
Because?
Well, the only reason I think is because a lot of influence from the bondholders, financial sector bondholders, don't like it. As I say, you don't have to be a genius to figure out why they don't like it.
Well, no, I mean, you know, it's funny. You said Bill the bondholder. I should say Bill Gross, the bondholder of PIMCO, and he's someone who's had a lot of influence, as have other bondholders, who have suggested that the moment that you effectively force these bondholders to take a haircut or to swap out into equity, you're going to undermine the entire bond market, and we're going to see some kind of cataclysmic disaster. Now, I'm not sure that's the case, and as you've seen in other bankruptcies, we've gotten through that. So at the end of the day, yes, this would instill more confidence, but there's other people on the other side saying that it would kill confidence.
There's also a lot of misunderstandings. I mean, I think that if the taxpayer really understood that their capital was going in, if you think about a bank that took in $25 billion of TARP funds, let's assume they have $400 billion of debt. That's a round number for a systemically important bank. $25 billion is enough to pay interest on $400 billion of debt for a year. So banks won't lend money because they need that capital to pay interest on their debts. I read a study by a guy by the name of Professor David Sharfstein at Harvard Business School, where he said of the $350 billion that was infused into banks, actually didn't go into banks. It went into
this was the original TARP money?
All right, it went into bank holding companies. Only something like $17 billion went into the actual bank. And I know this is a little technical perhaps for your audience, but I think it's important. The companies that trade in the stock exchange are called holding companies, and they're shells. They have debt, they have equity, and they own the systemically important institution. So the thing that we're worried about, that we want to protect, the deposit-taking institution, is actually a subsidiary of the holding company. And that's why systemically important institutions are structured this way, so that there's the investor entity, I call it the holding company, can be compromised. You know, the debt for equity of that entity can be converted without an impact at all on the subsidiary. So the thing that guarantees derivatives, the entity that lends money, you don't want. When Lehman failed, what happened was construction stopped, derivative counterparties tore up contracts. If they had been a deposit-taking institution, there would have been a risk. The beauty here is you can simply just walk your way, through the capital structure of the holding company and create enormous amounts of capital. Let me just follow it through for what it can do. Imagine if we did this across the 19. Well, let's not do it. You don't convert all the debt into equity. What you do is you set a standard. You say, look, we need these banks to be extremely well capitalized, which means they need to have a certain amount of capital. We now have all the data we collected from the stress tests. So each bank needs to have, call it, 10% common equity to total assets, and we convert sufficient amount of debt. If J.P. Morgan has a better balance sheet, you convert some. Less for J.P. Morgan, then you pick another institution that has a worse balance sheet. It's a very fair process. Once you do that, if the banks are now overcapitalized and you restrict dividends and you restrict stock buybacks, the only way the bank can earn an adequate return on its capital is by increasing assets. And what does that mean? It means making loans. Now you've got 19 banks competing to make loans. That has a huge impact on the economy, because the average businessman says, I can't spend money today because I have a debt maturity I can't refinance. But if he has 3 bankers knocking on the door, or 19 saying, I'm going to lend you money, he can start spending again, the economy can recover.
Wait.